Okay, I said that with this lesson we are going to look at demand and supply, and we are going to focus on demand for today's lesson, being our chapter 2. Previously, we had covered chapter 1, and I can see a message. I can hear you clearly. Good. Sorry, I don't know how it. Okay, that's good. Now, I'm saying that I would like to take this opportunity to welcome you to this lesson. And this is a continuation of our series on lesson on economics. And we want to focus on demand and supply for today. And would like to ask ourselves, what is demand? This lesson, we are going to focus on demand. Maybe our next lesson, we shall look at supply. But both demand and supply move hand in hand. When we are talking of demand, we are talking of the amount the consumer are ready to buy or are willing to buy. And we're talking about the supply is the quantity of items or quantity of supplies that producers are ready to bring to the market. So in this lesson, we shall focus on demand. And we say this, in any economy, there are millions of individual and institutions, and to reduce things to a manageable proportion, they are consolidated into three important groups. We have households, we have farms, and central authorities. Now, when we are talking about households, we are referring to people in a certain or living together under one roof. You are saying that household refer to all people who live under one roof and who make or are subject to others making for them. Joint financial decision. If you have a man who is married with his children, they make up a household. Then the amount of quantity that this household will use or they would like to buy, they will constitute demand. The household have a demand of certain items which are necessary for their existence. And under the household, we say that under the household, we are saying that in any return for the factor of services of production supplied, they get or receive their incomes. If you perform labor, you are paid wages and salary. So the demand of labor goes hand in hand with wages and salary. You are going to learn as we move on, when the wages and salaries are high, people tend to demand for those jobs, or people tend to demand for labor. When you invest capital investment, you get interest. When the interest rates are high, many people like to invest. When you give out land, you rent. When you rent land, the higher the prices of rent, people would prefer to give out their land. And finally, in any business enterprise, there are profits. So all these sum up what we are calling a household. Household basically will do the investment, and demand from the household perspective, we have summarized them in 4 categories: labor, capital, land, and enterprise. Now, the farm moves from a single family setup to an industrialized area. We say that the unit that uses factors of production to produce commodity, then sell them either to other farms, to household, or to central authorities. A farm can be considered like a company, like industries. They will convert produce from raw materials and they sell to either other companies or household and central authorities. So the farm is thus the unit that make up the decision regarding the employment of other factors of production and output of commodities. They are assumed to be aiming at maximizing profits. Now, about the central authorities, we say that this comprehensive term include all public agency, government bodies, and other organizations belonging to or under the control of the government. So, in any market economy, there are three categories of people. There is a household that comprises individuals in a single family. There is a farm, which in this case we are referring to companies, industries, and there is central authorities. In this case, we are referring to government. All of them, they come together and they play a bigger role in demand of commodities. Now, we look at definition of demand, and we say that demand is the quantity per unit of time which consumer are willing and able to buy in the market at alternative prices, other things held constant. So you may not be in a position to memorize this, the whole thing about demand, but what comes out here is demand is limited with time. If you consider during the COVID-19, the demand of mask and sanitizer were on higher demand for that particular time, which is not the case today. So the quantity that is required per unit time will give out the demand. Now, we have demand of individual and also you have demand by a market. Individual here referring to households, market here referring to the entire economical status. That means having the household, farms, and central authorities together. So the plan of a possible quantity that will be demanded at different prices by an individual is called individual demand schedule. Such a demand schedule is purely hypothetical, but give to explain certain law. And this is the first law of demand and supply, that more of commodities will be bought at a lower prices than higher prices. The law of demand is that the higher the price, the lower the demand, or the higher the demand, the lower the prices. This is basically common and practical in this sense. When an item is sold at lower prices, based on the purchasing power of individuals, they will go for many of them. If unga 2 kilograms is sold at 10 shillings, many people will go for it than when it is sold at 100. So the demand will increase. That's why you are finding this table explaining that the demand of an item, the amount of quantity demanded will decrease. The quantity demanded will increase with the decrease in the price. When the price is 20 shillings, the demand is 3. When the price is 10 shillings, the demand is 9. So the demand is inversely proportional to the quantity supplied. The demand is inversely proportional to the price, sorry. When the prices are high, the demand is low, and vice versa. Now, the table shown here explains the same thing. This is demand per week. Now this is the market demand. Yeah, market demand we have said is the entire economy demand. And they're saying theoretically, the demand schedule for all consumer of a given commodity can be combined to form a composite demand schedule representing the total demand for the commodity at various prices, which in this case we are calling market demand. The entire economy demand of an item, both farm, household, and government inclusive. So the same thing applies, that when the prices are high, the demand is low, and vice versa. Now, we can plot a graph of demand against price, and it will be having, in quantitative analysis, we say that when a slope move from slant this way, we are saying that it has a negative gradient. So in this case, we're saying that the price against quantity will be inversely proportional, such that when the price is high, the demand is low. Like price 1 is high, demand is low. Price 2 is low, the demand is high. So this case, this is how a demand curve will look like. You're seeing that the curve can also be drawn for the entire market demand, and it's called market demand curve. Now, market demand curve is the horizontal summation of the individual demand curves by taking the sum of the quantities consumed by the individual consumer at each price. So basically, when you plot a graph of price against quantity, then it will give you a downward sloping like that one. In this graph, we are saying each and every price, each and every item will have different demand of the commodity. Like in this case, we are saying when the price 1, then you find that the quantity demanded is less. When the price 2, you reduce the price, the quantity demanded increases. But under the same price, another item will be demanded more. Under the same price, another item will be demanded more. So the demand is not constant for all items. It depends on which items that are there. If, like in this one, is a combination of these two, but all of them have the same price. So when the prices are high, demand is low. When the prices are low, the demand is high. So you're saying that at price 1, P1 in the figure above, the consumer D1, demand is price 1, demand is Q1. Price 2, demand is Q2. Price 1, demand is Q2. Price 2, demand is, like in this case, they're telling you that the Q2 here becomes, you see this, in this case, this price here keep on, the quantity demanded keep on increasing based on different commodities. Now, we move on and ask ourselves, what are the factors that affect demand? When each and every person will buy an item based on several factors. There are people, when they get money, they start demanding items that were never in their life before. Like you get money, you start demanding to buy a car. You start demanding to buy. So means having money, the amount of income contribute to your demand. So we're saying that these are broadly divided into 4 factors, into factors determining household demand and factors affecting market demand. So factor affecting household demand, tastes of the household, how people prefer an item. If you are in a Swahili community, you are selling them viazi, they will buy. You go to another community, tell them viazi, they will not buy. Income of the household, when people have money, they tend to buy. No money, no buying. The necessity of the commodity, price of other goods. People will buy those goods which are lower prices. And we call it price of substitute goods. So in this case, we are saying that when you plot a graph of demand against price, it will be a linear equation, and the negative B means that the gradient is negative. It will obey a straight line, but the gradient is negative because there is an inverse proportionality between demand and price. So we are saying that when you have complements, the complement of a commodity are those used to consume or consume with it. Suppose commodity A and B are complements and price of A increases, this will lead to a fall in the quantity demanded of A and will in turn lead to fall in demand for B. For example, bread and butter. Complements are things or items that work, they work together. They are demanded together. Yeah. So when one item prices changes, it affects the other one. It's like price and exercise book and a pen. Yeah. The two of them, a student will require them in school. So when you increase the price of a pen, when you increase the price of books, student may not buy books, means that they also not buy pens. So substitute goods. Substitute goods are goods that can be replaced. Substitutes of commodity are those that can be used or consumed in the place of the commodity. And we're also talking the aggregate national income and its distribution among the population. When the country economy is doing well, then it means people have money and they're able to buy more. Taste and preference, you're saying that there is a direct relationship between quantity demanded and the taste. You see, each and every lifestyle of people determine what they buy. When the lifestyle changes, then taste and preference is also going to change. Now, there are theories of demand and supply. Like, what do you think will constitute demand or will make changes in demand? Like expectation of future price changes. When people when the supply of petrol is high, or the supply of petrol, people are expecting to increase prices. Therefore, they may end up buying more petrol today because they are anticipating that the prices will change. Even the seasonal fluctuation or climatic changes. Seasonal fluctuation affect the demand of certain commodities such as cold drink, like sodas and heavy clothing. When it starts raining, people will buy umbrellas. When there is no rain, the demand for umbrellas reduces. The size and structure of population, changes in population over time affect the demand for a commodity. When people are too many and commodities are less, then the demand will change. Yeah. Government also can affect the variation in prices, and also you can talk of advertisement. When you make more advertisement, then people will buy your goods. Then there are things, there are certain items which do not obey the law of demand and supply. We are calling them the exemptional demand curves. One is inferior goods. Yeah, they are goods regardless of the prices. People will not buy. Cheap goods, you cannot sell some. There are things you cannot sell them, even if you reduce the prices. You go and sell them to rich people, they will not buy. Yeah. So cheap necessary foodstuff provide one of the best example of exemption of demand. When someone is rich cannot go and buy food in a kibanda. Gifted goods, that is not carrying more weight. Like here, we are talking of article of ostentations. They are commodities that appear desirable only if they are expensive. People, they tend to assume that drugs are always they are always expensive. When you start consuming cocaine and the rest, you'll always say that things are very expensive, because that is what people have been made to believe. Yeah. So what are types of demand? One, we have in competitive demand. Commodity are substitutes if one can be used in place of the other. Substitute goods serve the same purpose and therefore compete for consumer income. When you want to buy a suit, and you go and buy second-hand clothes. All of them serve the same purpose. So if someone don't have money to buy expensive clothes, will go and buy second-hand clothes. So those ones, they are competitive demand. Joint and complementary demand, two or more goods are said to be jointly demanded when they must be consumed together to provide a given level of satisfaction. Yeah. And finally, we're talking about derived demand. When the demand for commodity is derived from the demand of a final commodity, that commodity is said to be derived demand. You are consuming this one because it has emanated from another source. Wood may be demanded for the purpose of manufacturing furniture and not for its own sake. After you have woods, you'll have sawdust. Sawdust is derived demand. Yeah. The demand for wood is derived from the demand of furniture. The demand of sawdust is derived from the demand of wood. Same to the demand of furniture. So there are those which are coming, they are demanded because something else came in earlier. So I want to finish with the composite demand. These are demands that are integrated among themselves. Composite demands apply to commodity which may have several uses or are demanded for several different purposes. Yeah. When you want to demand wood, you might use wood to prepare table, chairs, bed, windows, doors, and others. A change in demand for one of them will affect all other. If there is increase in demand for a table, this will result in higher prices being paid for wood. So this is introduction of demand, and we shall look at practical solution as we move forward. But in real sense, we are trying to say that demand is affected by so many things. But when you want to know the way the demand behave, you compare demand and prices. When the prices are high, people will tend to demand an item at lower magnitude. But when the prices are low, people will tend to demand an item more. So we are going to stop there, and we are going to meet in our next lesson, and we finalize on the remaining part of demand. I don't want to put a lot of information on the same lesson because movement along the shift along the demand curves is quite lengthy. We shall look at it in our next lesson. Is there a question? Kindly chat, give me a chat. Any clarification you like? We shall continue from there next lesson. Correct. No question, you're good. That's great. So we meet tomorrow for our lesson on financial accounting. For now, is a goodbye.